Hello, everybody, and welcome to the Monetized Advisor brought to you by JPTD Partners. This is a podcast for financial advisors who want to build, protect, and then ultimately at some point monetize your practice because you've put so much time into, in fact, in some cases, a lifetime to build these practices. So we want to make sure at this critical stage that you have the resources and you're prepared to make the right decisions. I am Peter Velarde. I am the P in JPTD, and with me is
Guys, I'm Scott the Jamarino. I am the D. And just for everybody knows, because everybody always asks, what is JPTD? It simply stands for John, Peter, Ted, and they call me D because of my last name. We're not that creative when it comes to branding.
No, we're not. We're good at some other things, but not that. So it's great to be with you all. I'm going to tee up the agenda and jump right into it. Between Scott and I, we have 80 years, I hate to say it, Scott, of experience, both recruiting, training, hiring, but mostly helping advisors go through the life cycle of survival to growth to scaling to exits. And we've done it times thousands and thousands. So we're delighted to be here today to share what we know, what we've learned, mistakes we've made, and mistakes we see other people making over the years. So, agenda wise, it's pretty action packed, and then we're going to jump right in. We're going to start with some news that you can use. We're going to hit two art articles, one in Advisor Hub, one in CityWire. And we're going to kind of draw some conclusions that we thought might be useful to you. Then we're going to get into the meat of it, which is going to be today's topic, which is comparing the different types of deals that we see out there. There's a lot of misunderstanding and myths, but we're going to help you understand what is a minority deal, what is a majority deal, what is a full deal. And we're going to spend most of the time on minority and full deals because those are the two most popular out there right now. To help you kind of see what type of person is right for what factors should you be thinking about as advisors. That's kind of the meat. And then we're going to segue into the section we call the advisor red flag of the day, which is the top mistake we're seeing lately that advisors make that we don't want you to make. And then we're going to hit on a section called Deal Me the Cards, where we're actually going to show you, not show you, but tell you and walk you through a real offer. We have the offer in front of us. Of course, the names have been changed to protect the innocent, as they say. But we'll walk you through a minority deal and a full deal to help you see the construct of it and think about yourself within that construct. Then the last part will be kind of our rapid fire takeaway. So, Scott, that's what we're here to do together, and it's our story, and I think we should stick to it. So let's jump in. The first article is in Advisor Hub. It's called The Power of Connection, Why Partnered Independence in the Future World of Wealth Management by a guy named Robert Milligan. I actually know who he is. He's a managing partner at 1792 Wealth Advisors, and he assumes some leadership roles there. But this was a really interesting article, Scott. It spoke a lot to some of the trends going on and what it means to advisors. The first thing, of course, when you think of what's going on in the industry that came up is AI and how AI kind of provides this dual-edged sword to advisors, right? On the one hand, it can be a threat in terms of AI, relevancy of doing things advisors can do. On the other hand, it's a tremendous enabler to help advisors and their firms become more competent, become more efficient. So, what was your take on that part of it? The clients we work with and the clients you work with, what are you seeing people saying and thinking about AI right now?
It's so interesting, this topic, because it comes up like every single day. And I usually see two different camps. I hear one camp that people say, oh, it's just a bubble. It's like, the tech bubble in the late 1990s, right?
Hmm.
It'll be gone tomorrow. And then you have, quite frankly, the vast majority who believe, this is here to stay. This is the next Google. This is the next internet. What's a web three, right? Web two and web three. So my my take overall and talking to people and coming to my own conclusions, I actually think AI is extremely beneficial for advisors. Um, and I think it'll be a supplement to what you're doing, and it's going to be an expectation, I think, especially from the younger generation. So right now, last time I looked, 38% of the workforce was under the age of 35, and that particular group is our future, right, in this industry. I think they're more and more apt to not only use AI, but also expect AI in everything from financial planning to service reviews to, maybe down the road you have an AI twin as an advisor. If you guys ever heard of an AI twin, but basically these big multiple Peter Villardis talking.
Hmm.
But
That would be scary.
let me scary. But leveraging technology, I think, is going to be a must have, especially in the AI space.
Yeah, I think that's so true. I think that the headline that comes to mind that all firms are playing for, small, medium, and large, is the concept of value expansion. Because right now, the reality is AI can probably do 5 out of 10 tasks that an advisor delivers to clients. So that could be a little scary on the one hand, right? Because it's like, okay, well, how am I going to continue to charge my 1% fee if half of what I do can be outsourced through this new technology? So, on the one hand, it's going to be really important to me, and what I got out of this article also, to continuously think value expansion. What can I do and what platform should I use and what firm should I be with that can add the most value to me to help me expand the value of what I provide to clients. On the other hand, it is such an incredible potential tool for every stage of how you deliver that value to your clients. Everything from lead gen in the very beginning through what you do to actually deliver client value along the way. And it's going to move, it's already moving very fast. I mean, I'm a boomer and I use AI probably 5 times a day. Scott, I'm sure you're the same way. And so that's a really big deal. So the headline there for all of you is to pay attention to what's going on in the industry and make sure you are do everything you can to add the most value, and then make sure that you're taking full advantage of the technology available, whether it's lead gen, referral automation that I know a little bit about, what you do to deliver to clients and everything else. So that was kind of the first headline.
You said real quick, you said something super important I want to make sure we don't
Sure,
miss,
man. Go ahead.
is the fact that if you're not adding value, people aren't going to pay you your 1%. you know,
That's
you're going
simple, right?
you're going to see margins condense and condense and condense if you're not adding that extra added value. And then when you're seeing your margins go down on your top line revenue, and this kind of goes to our world, is your EBIT is going to go down. Okay. When your rebates go down, you're not going to get the same value on the street when you're looking to potentially sell your business down the road. So that added value, making people's lives easier, always coming up with new and fresh ideas, has to be in play in order for you to maintain that revenue stream and retaining the clients.
So true. I had a conversation with a client yesterday about, and he was asking me, how do I add more value? And one of the categories I talked about was behavioral finance, because part of the way advisors add values is as a coach. But a lot of advisors don't know how to do that. I think about our days of emotional competence training, Scott, behavioral advice, the things that we all do every day, but getting really conscious of that extra value about how do you get people to make good choices in the presence of fear or competing emotions.
Yeah.
So that was theme one. Theme two was more about M&A, where he made a big deal about talking about how M&A is no longer there just to cash out when you're ready to retire. That it's emerged as, so that was always perceived as being the finish line of an exit or monetization. It's really shifted today that now it's a major growth strategy for companies. Share with the viewers a little bit more about, why is it a growth strategy? What does that look like, Scott?
So it's funny when we first started JPTD, was it 5 years ago, 6 years ago?
Hmm.
I thought that our average age client would be like late 60s, early 70s, somebody who's ready to sell and go to a beach someplace. Actually, our average age client is 47, 48 years old, which
Mm,
means they have another 5, 10, 15, 20-year run in them. And the re and it's just been interesting talking to these folks because the reason that we're finding this is in order for them to, because a lot of these folks have hit the ceiling of complexity, right? So in order to 3x, 5x, 10x their business over the next 5, 10, 15 years, they're going to have to they're going to have to do something different because they spent 20 years to this point getting to where they are today. But what they did over the last 20 years is not going to double, triple their business over the next 5 or 10 years, as we talked about. So they got to do something different. They need support. They need help.
mm.
So two things. One is most of the buyers will say something, Peter, to the effect of, "Hey, Pete, if I could free you up a day, day and a half a week, what would you do with it?" Because the fact is, if you have free time, you could get deeper share of wallet with existing clients. You could get new clients. You could take a vacation to make sure you're rested, right? So all of these buyers, for the most part, have suites of services to free you up. I'll take over compliance, technology, marketing, bill pay, HR, family office services, tax and legal services, et cetera. And so the idea is to help you grow. Second of all, if you want to grow inorganically, a lot of these buyers out there, that's part of their strategy. And they love advisors who have a desire to grow through acquisition. So a lot of these firms out there will not only identify potential recruits, potential M&As to buy, they'll also negotiate it, they'll pay for it, and give you, the advisor, the economics. So there's a way of growing organically through freeing up time and inorganically through practice acquisition.
I think that's very well said. When it comes down to it, it's harder to grow the bigger you get. And every business hits that ceiling of complexity where principals are trying to attain their highest and best use, but they're dragged down by the opposite and sometimes can't get out of that. And sometimes bringing in a great strategic partner can kind of unleash that next degree of growth. Last thing in this article that was super interesting, which we've hit on a bit already, so we can do this quickly, is it's human connection that drives that value that we were talking about. So we're getting at this whole value expansion. It's that connection that people want. And so buyers aren't just out there, our partners. We have 110 acquisition partners that we refer our clients to in every shape and size, but they're not just looking at the economics, they're looking at the people. And, there's this good guy, good gal kind of rule out there. If people aren't good humans and good connectors, they'll figure that out real quickly on a couple of calls that we call dates. And so that's super important. We've seen deals work especially well when you've got a super healthy business led by really good humans. And so it's something to pay attention to, not just in the exit phase, but along the way. It matters, and it's going to matter more with this new world of AI. Any quick thoughts on that, Scott?
Yeah, real quick. We're seeing consistently what's Peter 4 to 7, 4 to 8x top line or 8 to 16x EBITDA on deals, right?
Sure.
And people are always like, well, what's the difference between a 4 and a 7 on top line or 4 and 8 on top line? And obviously, size does matter. And
Hmm.
then there are dozens and dozens and dozens of other variables that come into play that will get you the higher multiple. But one of the ones you just hit on, and what nobody really thinks through, is the likability factor, right?
Hmm.
And so, and I've been on a lot of calls where I'm telling some of our clients, "Hey, Pete, smile. It's
Hmm.
okay to smile. It's okay to be yourself. It's okay. It's okay to like joke around a little bit because
Be authentic, right?
you got to be authentic because you know, if you're joining a firm, one of the things they're thinking about is if I'm taking you to a national conference, I want to say, this is Peter Velarde. This is our newest advisor that just joined us. And they want you to fit in like a glove. So culture, environment is really about fit, right? And part of fit is personality. And so that piece of that likability factor is something just not to discount because it could mean the difference between in terms of millions of dollars for you on the back end.
So true. Well put. Second article, also interesting. So we'll get you a link to that article. Would encourage people to read it. Second one was by a guy named Gary Roth, who's a co-CEO at Modern Wealth. This article was kind of an opinion piece on soaring equities and record M&A are a dangerous combo for today's RIAs. So he spoke a lot about kind of the risks ahead and kind of this period of time of maximum certainty of uncertainty going on. So, uh, and he begins by talking about markets are really high right now. I think we've been in what's got a 14-year bull market. And so people are starting to look at this. And for the first time in a while, we're seeing valuations plateau. They've been going up for quite some time with the markets, with the interest of private equity, private capital, family offices, taking bites out of these super RIAs and them taking bites out of everybody else and driving valuations. But it's starting to slow down because now we're into the supply and demand where the average age of the industry is 62. There's a third of the industry turning over. And what's happening is there's now more sellers than buyers, whereas before there was more buyers and sellers. So we're getting to this point of kind of this window that we've been talking about for years with our clients. But what are you seeing out there? Are your clients concerned about this? And how do you kind of talk about, we're at peak M&A, peak stock market? What's that mean to an advisor, Scott?
So 3 years, 4 years ago, 5 years ago, when we started this, I was like, these numbers are crazy. The multiples,
Hmm.
because you and I were both brought up in the world of 2.5 to 3x recurring revenue, where the advisor had to get out after 12 to 18 months. Um, but then we started seeing, like you said, the 4 to 7s, 4 to 8x top lines and the 8 to 16x EBITDAs, and we started seeing deal flow come our way. We're like, this is real. Now, how long this lasts, who knows? But right now it continues to rage. We haven't really seen a hit on the multiples per se, but there are some signs going forward that they may not hold, right?
Hmm.
So, for example, Peter, you just mentioned one of them is the markets are still at an all-time high or close to it. The markets come down. If we have a recession, that's usually a 10-20% hit on the Dow, which means your valuation is immediately going to go down, or you need to get up 10-20% to make up the earn out down the road. Number two is, and we're not CPAs, but number two is right now, the vast majority of the consideration, what they buy the practices for, is considered long-term cap gains. Check with your CPA. I'd make sure I get that in there. But if they ever change tax laws, that could be a game changer for folks. The other thing that people are taking into consideration is a lot of our 110 buyers may be buying each other up. So to your
Hmm.
point, we're seeing there may be less players that are vying for practices, which means you're not going to get the bidding wars that you're getting today. And the last thing is a couple of personal things, because we've seen this. You never know when you're going to walk in on a Monday morning and you can have a compliance issue. If you have a compliance issue, you're untouchable. Nobody will want to go near you, number one. And we've also had situations where people have had health issues. So the
Hmm.
longer folks wait, the more risk you take in all these factors we're talking about. That's why it's important, I think, now to at least see what's out there to find out what your value is and what you need to do to structure your practice properly to maximize the valuation while the going is good.
So important. And isn't it interesting how when everything is going great, you have that kind of this relevancy bias where people think it's always going to stay that way, right? Like it's not really hard to acquire or take care of clients when everything is up. But those of us that have been through, 2008 and post COVID, all of these corrections, crashes, whatever it is, we know that a business life and a personal life changes in a big way when things are going south for a while, and they always go south for a while, and they always come back. But during that period of time, bad things can happen. So it
Well, Peter,
rarely stays the same.
it's funny you say, 'cause, think about it. Most people, most private equity folks, buyers, most advisors weren't around in 2008 and 2009.
No.
You know what I mean? So you don't know how you're going to react if and when that happens. I mean, it's at some point in time, we're going to see a correction. What does that do to your life? What does that do to clients? Does that force clients to reevaluate what they're paying you with that value add you talked about earlier from the earlier article? So the chances of outflows, clients taking their money going someplace else, are a lot higher. And as you take on more risk, is what I'm saying, which again could impact your valuation down the road.
Right. So what we coach people on heavily is to understand risk on both sides. What's the risk of waiting? What's the risk of doing it? It's kind of like life to me, where if you end your life with regrets, most of what people regret is not what they did; it's what they did do. It tends to be more of what people regret. So a cautionary tale is, we're at the peak of the real estate market kind of place. If you have a house that you don't use all the rooms in your house, if you could sell some of those rooms, you would want to. And the other piece that I think a lot of advisors wake up one day, Scott, and see is they wake up one day and 80% of their net worth, because their practice is worth so much now, 80% of the net worth is tied up in one asset,
Right.
and it's not liquid as an asset. Producing income, yes, but not. So it's something that gives people pause to say, maybe I should poke my head up at this peak, and think about what are my options and what should I do.
Well, it's kind of like we're going to talk about the fractional versus full deals. Even if they sold 20, 30%, okay, take some chips
Yep.
off the table, live to fight another day. We'll show you some examples of that in a second.
Yep.
Um, Understand what the market is right now, what your options are, will give you clarity. It'll give you
Absolutely
clarity
true.
important to you, and it'll also give you clarity in terms of if your business isn't prepared to sell at the valuations that you want, what you need to do going forward in order to make it, to ring the bell on it.
Yep, perfect. So let's do that. Let's jump into minority versus full deals as a start. I think most of you know a minority deal is where somebody comes in and buys a minority percentage of either your top line or your bottom line or your EBITDA. And both exist out there. And it could be anywhere from 10% to maybe 49%. So, um, who's right for this type of deal? I'll start with the minority deal, and then Scott can do the full. A full deal is they come in and buy 100% of everything. Sometimes you become an employee, sometimes you stay an independent contractor, but that's the maximum way to de-risk, maximum way to get lots of stuff off your plate. And so that's for a certain type of group. So let's kind of jump into it. So minority, let's start there, and then I'll have you hit majority, Scott. So generally, a minority deal tends to skew somebody who's younger, that is growing very, very fast, that has got very strong operational excellence and can keep growing on their own, but is looking for a few things. They're looking to de-risk a bit at these market highs, some percentage. They do feel that they've got some gaps in their operations, marketing, practice, management, or they need capital to expand. There's some gap or gaps that they would benefit or feel they'd benefit from a capital partner, a strategic partner that comes in, takes a bite of their apple, and is more a menu of support for them. Those people stay as an independent contractor. And you, in essence, have a partner in crime. So you're not doing it alone. Tends to be best. I had a lot of deals, especially in the beginning when we started JPTD, but I'll do 3 to 5 minority deals myself each year. And it tends to be people that are very independent, that have hit some type of element or elements of ceiling of complexity. And they've started to realize, for me to really keep growing, I'm going to need to invest a lot in this practice and take a hit on my personal cash flow. So, and I've only been growing organically. I think there's a whole big wide world out there to grow inorganically with a capital partner, but I'm not really great at M&A. I need a partner that's great at that. So it's that kind of profile. The way the deals are structured, is simple. It's a percentage of one of those two things, top line or EBITDA. It usually comes with a lump sum. So if somebody buys 20% of a million of rev, they may be buying 200 of rev. And if they're buying 200 in rev, what they'll do is assign a multiple to that of somewhere between, for let's say a $2 million practice, somewhere between 4 and 5, somewhere in there, and they'll pay it to you about half of it up front and the other half as retention and growth earnouts over maybe a 2 to 4 year period of time. So you'll get what's called your consideration out if you hit those targets, and they're designed for you to hit them. They want you to hit them. They do best if you hit them. They're going to support you to hit them. So they're going to make a bet that if they buy a piece of you, you're going to grow faster than what you were before. So part one is kind of the consideration that's upfront and earnouts. Part two is a payout that will come, and that depends on how much they're buying. Some companies will pay the same percentage of expenses. Some companies won't. There's pros and cons to each. And then most minority deals, the equity component does not come up front. It comes in the form of a tag along. So the way that works is if they're buying 20%, they'll give you the option, rarely mandate. Sometimes it's a drag along, which means they're going to require you sell some more equity if they have an equity event. More often than not, it's a drag along. You have a choice to sell some more of your cash flow or revenue. It could be another 20%, it could be all of it. And some of them, and you get to participate in their multiple. And that's a win-win because there you may be going out at maybe 4 to 5 times rev, or maybe 6 to 8 times EBITDA. But their exit, if some firm takes a bite of their apple, they'll be 2 to 3 times that, and they'll give you some participation in that. So there's big bucks on the back end, and now you're rooting for that team and your team to grow. And there's a massive alignment of incentives. So that's kind of what that looks like. Lastly, factors to consider would be things like, what are your pain points as you're growing in your growth plan? And can you solve those pain points alone, or do you need a partner? The more you need to get off of your plate to achieve highest and best use, the more you're going to want to skew towards a full deal like Scott's going to talk about. You also want to think about how much you want to de-risk at a point in time, and that could be age related. If you've got 3 to 5 years left, you may want to take all the chips off the table. If you've got 10 to 15, you may want to explore both options and see what works best for you. But it's a matter of timeline, what you perceive about risk. Your health could be a factor in all of this. The more unhealthy you are, the more chips you should take off the table. The less healthy you are, the more chips you want to take off the table. So it's about risk tolerance. What has become very unique, to segue into Scott. So that's kind of what a minority deal is. Scott, when we started, the majority of deals we did were minority deals. The average age of our client is 48. And they're growing, they've got runway ahead. So the beginning, it was like, hey, these will form fit. But then a funny things happen. A lot of these full acquirers, whether they're aggregators or integrators, began saying, wait a minute, let's create deals that are what they call have your cake and eat it too, where in their deals, you can de-risk 100%, but they build in all these growth incentives so you don't have to save any powder anymore. And the headline of all this, and Scott's going to talk more about that, is that now you've got legitimate choices. Generally, we provide our clients with both options and say, hey, have an open mind. You're going to be shocked. And in some cases, the people that came to us and said, I only want a minority deal, ended up doing a full buyout. And some of our clients that came in saying, I only want a full buyout, ended up doing a minority deal because there's trade-offs to both. So Scott, I'll turn things over to you. That's the world. Talk a little bit about the world of full deal.
So by what you just said at the end there about understanding options, a lot of advisors, a lot of our clients don't know until they actually get out there. And again, this is why part of this educational process we go through. So, again, it'll help you gain that clarity that you're looking for to make the right decision for everybody. But 3 years ago, I looked at it. 3 years ago, 65% of our clients did fractional deals. Today, it's just the opposite.
Mm,
65-70% are doing full deals. So what a full deal, to your point, is essentially we'll buy 100% of the practice at that 4 to 8x top line multiple that we talked about. You'll usually get 60 to 70% up front. And they'll say, hey, Peter, let's say it's a $10 million deal, make my life easy. We're going to give you 7 million up front. How much of that would you like in our stock? Would you like 5%, 10%? We've seen all the way up to 40%. The reason that's important is historically the buyers every 3 to 7 years may have their own equity event. And you own like a stock option or restricted stock where you can basically cash out. What you'll hear a lot of the buyers say is that you could make more money on their equity event than you could in just selling your own practice. So whether that's true or not, that will remain to be seen.
mhm.
Um, but all the buyers will say our stock is the next unicorn. So, you just don't know. That's the part of the due diligence process. So anyway, that's part number one. Part number two is the earnouts are the exact same as a fractional deal. It's usually based on two factors to your point, which is revenue retention. So if I'm at 5 million of revenue today and I'm still at 5 million of revenue 2 years from now, Peter, here's another chunk of money. And the
Yeah, man.
second is on growth, which is compound annual growth rate. The normal target is 10%. So if you're growing top line revenue at 10% per year, whether that's including the market or not, they'll pay you the last piece. We try to negotiate pro ratas on that. So if you grow 9% versus 10, you'll get 90% of that last payout. And sometimes we're able to get you mulligans. So if it's a bad year, you lose a big client, maybe we can add an extra year at the end that you can make it up if you wanted to. But it's funny, the multiples on fractional deals versus the multiples on full deals, for the most part, are identical. We do have
Mhm,
a couple of people out there that will, depending which way they want you to go, may give you a little bit of a premium on the multiples on
mhm.
one side or the other. But for the most part, it really doesn't matter to them because they want you to be part of that. Understand though, if you do a fractional deal, it's not like you're going to be able and you sell 30%. It's not like you're going to be able to sell 70% to somebody else in another organization.
Mhm.
You're not going to be part of two RIAs or two broker dealers. You're kind of tied to it. But anyway, so a full deal is usually a W-2 deal. Payout rates usually are between 25 and 35% with no expenses. And sometimes we're able to negotiate a retirement plan for you. Not always, but sometimes. What that looks
Mm.
like is for a period of up to 5 years, you could get upwards of 50% of the comp that you were getting beforehand through a junior senior comp split with your G2. Now that's ordinary income versus long-term cap gains, but that's extra consideration. That's extra money for the seller between the upfront, the stock, the earnouts, the comp, and ultimately the retirement plan.
Beautiful. So we're going to do a deep dive in about 2 minutes into actually two actual offers, and we're going to fill in the blanks and tell you exactly what the offers were. We got clients between now and then. Scott, I just want to hit on biggest mistake we've seen lately quickly, and then we'll segue into that, and then we'll close. So the one that Scott and I kind of agreed on lately, we're seeing is poor financials, not organized, not stored, throwing in everything from country club to coffees with your significant other that we have to, redact out of the P&Ls. So just talk a little bit about what the impacts are. So, and we see poor financials certainly involves more work on our part to get them in a place and into a vault that can be consumed quickly by these firms. But what say you about the impact of that to advisors?
Well, first of all, a number of things that we screen for are things like, do you run it like a business versus running it like a financial advisor? There's
Hmm.
a difference. So a business, you have processes, you have systems in place, you have people in place where you can scale the business. Um, People that run it like a business owner will always get a higher multiple than someone who's just selling A shares and annuities, right? And part of that is expense management. So when you think about your true operating expenses, not including kids' cell phone bills or your country club fees, to your point, the good ratio of expense to top line is usually 30, 35%. Now, we've seen people, Peter, say, hey, I run this thing really, really lean. And that's great if you're growing double digits. But if you're not, the buyers may see that as a lifestyle business and they're not interested in lifestyle business because they want you to grow. On the flip side, we've seen people at 58, 60% of operating expenses to top line revenue. And there's no way they'll come near you just because you're not running the business properly. So we can educate you. We could walk you through what benchmarks are when it comes to managing your business overall because we know what they're looking for.
Yeah, and the headline, thank you, Scott, is that you can overinvest and you can underinvest. If you underinvest, then it's an issue of in order to grow faster. If you can underinvest and grow fast, not a terrible thing. But if you overinvest and don't grow, that is a terrible thing. So if you spend too much, but it doesn't lead to results and growth, it's likely you run a practice and not an enterprise. So we'll give you a good education about what that sweet spot is and how to get there quickly. But that's one of the first things you want to start to do is organize your financials. Think of it as an enterprise. I'm showing somebody 3 years of my P&Ls. Would I be proud of this? And kind of look at what your margins are and say, is that in that kind of 35 to maybe 50% sweet spot? If you're in there and you're growing above market by 5 or 10%, then you become a viable choice for people to partner with.
Yeah,
Um,
I'd add one thing is when you think about your top line revenue, remember it's called gross, which is your true GDC before platform fees, before
Huge deal.
before payout grid. So a lot of advisors have no idea what they're spending, what their cost is on that platform fee and payout grid net. But usually we get you back up to gross, because that's what the multiples are historically based on.
Very, very true. So this next part, we just want to hit on and fill in. This is should be called fill in the blanks. So these are actual offers. I'll go through a quick minority deal. Scott will do a quick full deal, and then we'll do a wrap. And incidentally, if you want to see more offers, just go to jptdpartners.com. We've got cases and offers on the top line. We're completely transparent. These are real. Of course, we take the names out to protect you and them. So you'll see lots of them, hundreds over the course of a year. So I'm going to talk about a fill in the blanks. This is a hybrid RIA acquiring a pure RIA. This RIA is about 2 mil of rev. And this is a super fast growing hybrid RIA that has not had any exits yet. A great partner of ours. And they're buying 30% of the top line rev. So here's the specifics. So it ends up being all in about a 7 times rev deal or 12.34 times EBITDA deal. And it's made up of these components. A check up front of the close for 2.4 million. Because they're going to move over to an LPL platform that they were not on, they're also going to get $1 million or so of transition compensation from LPL. They're going to get a retention payment in 24 months of 600,000, and a growth payment tied to CAGR at 36 months of 600,000, and then another growth payment in 48 months. So 48 months, the consideration part has been built out. That comes out to be 5.2 million, buying 600,000 of revenue. Pretty darn good. Very high deal. And then there's a tag along. I won't go through exactly what that is, but the tag along, if the firm has a bite of their apple at 16 times the EBITDA, which would be low for this firm, incidentally. We know this because they're also a client of ours. We're taking them to market as well. That would add up to another 5.5 million of participation in theirs. So for 600,000 of rev plus what they sell, the whole thing comes out to deal value of about 13 mil two. I'm sorry, 13.7 mil on for a $2 million firm with a lot of support and independence along the way and a payout along the way of 65%, which is strong for something like that as well. Because what you're really doing, remember, when you sell a piece or all of your practice, it's like you're going to get $10 paid to you today at cap gains rates. Consult with your CPA versus $1 a year for 10 years. Some dynamic of that's going to kick in. So you wouldn't ever expect to sell some of your forward cash flow, but also get paid the same payout. So your cash flow in the way, but what'll happen is you're going to grow so fast that you will get your cake and eat it too. You're going to get your money to invest, do what you do, but you're also going to get a payout that you can get back to net earnings where you were before if you grow and more often than not, advisors grow twice as fast post deals as before deal. So that's an actual minority deal. Scott, you want to do the same for a full deal?
Yep, I'll use round numbers. So we had a $4.5 million top line revenue team. Their EBITDA was 2.2 million. So basically 50% EBITDA, which is a combination of take your top line gross, you subtract off your true fixed expenses, rent, marketing, staff, etc. And then they take 35% of the top line to pay the advisor to run the business. So $2.2 million of EBITDA. We got a 14.35x on that, which comes out to $33 million. So a $4.4 million team got 33 million bucks. 21 million was paid up front. So again, so it's 21 of the 32 of the 33 million. So there's $12 million left. And then, by the way, out of that 21 million, the client decided to take $2 million that in stock. So 19 million of cash, 2 million in stock. At the end of the second year and at the end of the third year, if they were still at 4.4 million, so this is the revenue retention earnout, okay, they got another $4 million each. And then in the end of the fourth year, they had that CAGR target we talked about at 10%. So if they hit that 10%, they get another $4 million to equal the final $12 million. So again, $4.4 million team, $33 million in total consideration. The payout rate was a W-2 model. The payout rate was 35%. Out of that 35%, they had to pay staff salaries out of that, as well as paying themselves. So it's a payout rate, not a salary. So the more they grow, the more that 35% grows. And finally, and this is the retirement piece I talked about, when they retire, they would do a junior-senior split with the G2, with the successor. In this case, it was for a period of 5 years. And they estimated if you're growing 10% per year, it's an extra $6 million in the retiring advisor's pocket. So the total deal for a $4.4 million team ended up being 38 million bucks.
I bet that would surprise a lot of people, Scott. And that's the world that we're in. You know, we often ask our clients, what do you think this is worth? And then there's times when all in, we can get them 1.5 to 2 times that. And there's a lot to it to get there. It can take 6 to 8 months to get there, but this is a big wide world that advisors are just starting to really learn about. So thank you for that. Let's wrap up with a couple of quick headlines. I'll start. If we were to say, you know, what do we want advisors to take away from this podcast? I would say one is don't preconceive what this world is like. Just have an open mind, but at the same time, take action. Now there's a window of opportunity. The sand is shifting faster right now in your world, especially with AI, than I have seen in 40 plus years. So the last thing you want to do is miss this window and miss this opportunity. There's an old saying that I've said for years and all the roles I've been in that says, on the plains of hesitation lie the bones of those who failed to act. And that's my message to you is explore this. Don't do this alone. There's way too much to it. We've been doing it between four partners. We've got well over 100+ years of experience on all sides of this. There's a lot to it. You could make a lot of mistakes, but take action to at least explore. But have an open mind. Don't worry about minority, majority, full deal. Let us educate you and show you what market really looks like. Scott, what would you say?
Well, first of all, you took the words out of my mouth. Don't do this yourself.
Mm,
Every professional athlete, every actor out there, celebrity actor, all has representation because there was the little things that you've never even thought about that can make the difference in millions and millions of dollars for you. Number one. Number two is that Pete, I don't think this is going to last forever. Okay,
mm,
there's an opportunity now where it's great to be a financial advisor. Okay, but you owe it to yourself, you owe it to your staff, you owe it to your G2s, you owe it to your clients, you owe it to your family to at least explore this. What breaks my heart, and you asked this question earlier, one of the things that breaks my heart is when I hear about an advisor that does a deal and they got one offer. Okay.
mhm.
And I said, what did you get for your business? And they tell me like, oh gosh, I wish you called us. We could have got you so much more, because we're getting premium pricing for our clients. And so you have nothing to lose by just going to JPTD Partners website, clicking the button, have one of us contact you and talk to you a little bit because we're seeing 20 deals a day. We know where the industry is. We know where the puck is going. And we know what these folks are looking for to buy great practices. So take advantage of it. Doesn't cost you a dime. It's an hour of your time. I think it'd be well worth it for you.
Beautiful. Thanks for sharing, Scott. So, have an open mind. Go to jptdpartners.com. Play around on our website. There's offers on there. If you want a free business valuation, you can click a button. We'll give you an idea about what we believe the market, the true market value, not a business valuation market value, because what people are paying is what it's worth, which is not necessarily what a service would put together for your business valuation. So go check out our website. We're here to help. We'll send a follow up links to the podcast and to the resources we talked about today. Scott, great partnering with you. Thanks for being with us. And thank you all for spending some time with us today.
See you guys. Thanks.